You created the W, you got acquired the Sheraton, you did a lot more, but you made a little the Westin. We can go on and on. You were like the hotel guy for a long time, and I guess you still
I was
are.
a real estate guy before I was a hotel guy.
Okay, all right.
Now I'm back to being a real estate guy and a hotel guy.
All right,
you know, we have started hotels again.
So you started hotels again, but you've broadened out. I mean, I'm looking at some of your investments lately. Yeah. You're doing a lot right now in the sort of AI data center infrastructure business. That's become a huge component of your business, isn't it?
It has recently. I mean, for the last 5 years, we've been doing data centers.
Yeah.
And we started really in the Dulles market, the largest data center market in the world. It's 8.5 gigawatts in place. And Dulles was the home of the internet. And then, so there's great connectivity. And it's sort of ground zero. It's like Park Avenue and 57th Street. Yeah. And then we've broadened out to other markets. We did a deal with a Bitcoin miner.
Yeah, and with Mara Holdings, right?
Mara Holdings, and we're looking at others, and then we're expanding other states. And we've, with 2 platforms, we've launched into Europe and into Asia. Yeah. Both directly and indirectly. In Europe, we have the largest data center operator. We own the majority interest in largest data center operator in Ireland, which has expanded a joint venture with the Spanish utility, Iberdrola. And then we've also got sites in Milan. And then in Asia, we bought, together with Warburg, a controlling interest in ESR, which is Asia's largest real estate asset manager. We took it private last year, and they have a big data center business. And then on our own, we partner with them, with ESR, but also have moved into Australia, and then we're looking in Japan and Korea also. And we've been in and out of Malaysia. We haven't bitten the dust yet, but I don't know if bite the dust. I don't think that's the right word. Bitten the bone?
Bitten the bone. Well, we'll talk about ESR, because ESR is pretty expansive. I mean, that includes South Korea, Japan, India. I'm probably forgetting a couple of nations in there. That gives you a pretty broad footprint there. Why did you lead that deal?
We like their footprint in the new world. They're leaders in logistics, the largest or second largest neck and neck on logistics, with a huge footprint in Australia, which is a super healthy market. We did a large investment into Sydney and Melbourne in industrial a year and a half ago. And also, we like Japan. You know, it's done great with their abandonment of the yen and the fact that they've become so competitive while letting the currency go. So ESR has had a really good footprint in really the fast-growing countries, and we think Korea was distressed, but coming out of that. And they're great developers. They've done some great development deals all across Asia, including India. And they're about they were 150 billion. We've shrunk them down to about 120 billion of AUM, assets under management. We're about 130. Wow. And we're long, as a firm, more Europe and the U.S., and they're long Asia, so it was complementary to what we were doing. Yeah. And we were working with a group of investors. We took it private. It was I think it was the largest privatization in Asia last year.
It was, yeah.
So I think
would you have done that? I mean, you mentioned Japan and obviously the big changes that we've seen in the yen and fiscal policy over there. Would you have done a deal with such close ties to Japan, I don't know, 5 years ago, 10 years ago like this?
I think those two asset classes have caught the favor with investors, and a lot of their clients are sovereign wealth who invest with us. So we could do diligence to how they felt about ESR as a manager. And ESR was a sort of a funny company. It was listed on the Hong Kong Stock Exchange, but didn't really pay a dividend. Most asset managers pay dividends, and they grew at hyper speed. And so the markets then they had a lot of exposure to China. We think we valued that market appropriately, but they're a big logistics player in China. It's one of probably the weakest logistics market in the world that I'm aware of. And but I think we valued it well below book, and we bought the company, I think, attractively. We put together a consortium that includes some of the original shareholders, just rolled over into our privatization. And then we put, a really good group, including some of those sovereign wealth funds, joined us in the take private. So it's going really well. I've rarely done a consortium deal. We're doing deals by ourselves, maybe one partner, but there are 5 of us invested. But we've all agreed on the business plan up front, and we're executing. And the team's good and focused, and I hope we can grow it dramatically and then re-IPO it.
What about the Telstra deal in Australia? I mean, how important is that market for you right now?
Australia is a good market. There's trunk lines from the U.S., and there's no data sovereignty issues. I think both in Europe and Australia, and to some extent all of Asia, we've seen the hyperscalers who are really focused on the U.S. In the last 6 months, they seem to be really focused on moving out and not abandoning the U.S., but they're much more active in Europe. They're much more active in Asia. And we're working right now on our first real data center deal on our own in Australia.
Are the economics and the valuations a little more attractive there relative to, say, what we're seeing here in the U.S.?
No.
No?
The same.
Really? Oh,
Yeah,
wow.
pretty much the same.
Yeah. Is there more upside, maybe? I mean, why chase that? Why not just continue, roaming around the U.S. and try to
if you can get
buy
power
land
anywhere in the world, you
Yeah.
have something you can talk to a hyperscaler about. So we're just agnostic.
Yeah.
And, the interest rates are about the same in Australia as they are here.
Yeah.
And the yields on cost for us developing are about the same. And the equipment costs the same thing, and we have equipment problems everywhere. It's not just the U.S. You got to order your turbines and your chillers and your other equipment, and the labor seems to be okay. It's not. It's really Melbourne and Sydney, pretty much. It's not. It's not across the country, and our partnership with Celestra is a great help, and they've got sites, and we're working on one of them. Hopefully, we'll get it done very shortly.
What about your footprint in Europe? Because that's been expanding too. In fact, it seems like you're putting a little bit more emphasis on that than some of the other
real
regions.
estate guys like us, we like to invest with positive leverage, when the yields on property are higher than the cost of debt, and that turned true in Europe a lot faster than the United States. So we just took private. We bought a Swedish home builder. We thought that market was interesting. It's undersupplied. We have a huge owner of industrial in northern Italy, which is that's a good part of Italy from an investment standpoint, and the south is not so hot. But that enjoys a 2% vacancy rate. We're seeing growing rents, and we're getting inbound interest to buy this stuff. We've been very constructive on take privates of small public companies in Europe. There are a lot of small REITs in Europe that can't get to scale. And they were quicker to actually, let's say, clean the books, or shareholders got stuck and wanted to sell a company. So we continue to comb through the public markets looking for things to take private. There's a couple companies working on right now. And I think really more on the continent than the UK, because rates are higher and the economy stayed stubbornly weak. I'm not really worried about the European economy going into a deep recession. It's interesting. We have a footprint in Germany with a very large developer, and everything they touch, everything they open for lease, immediately pre-leases.
Yeah.
So we just achieved the highest rents we think ever in Berlin on an office deal we're building. So it's I think those markets are inherently better than the markets in the United States in the sense that the vacancy rates are much lower.
Yeah. Have you given up on the United States?
Not at all.
No?
Not at all. We're just waiting for Kevin Warsh to bring rates down for us.
You think Kevin Warsh is going to do that? Let me rephrase it. You think he's going to have a reason to lower rates?
Well, I'd argue if oil spikes, he should lower rates, because oil.
That seems counterintuitive.
Because interest rates aren't going to affect oil prices, right? But on the other hand, oil prices are a tax on the U.S. and the global economy, weakening the economy. So he should lower rates and help the interest rate sensitive parts of the economy, like housing, to balance the economy and keep it going.
How much room does he even have to do that? I mean, a quarter point isn't going to do anything for anybody.
I think the short end could be 3.
Really?
Oh yeah.
Wow. Okay.
It was 3 before the war. The forward curve was.
It was 1 at one point.
It was 1. No, I mean, like 6 months ago, it was in the fall, it was 3, the forward curve. And I think the U.S. economy is sort of a weird economy. We talk about this GDP growth and the exceptionalism. That's true from the AI's perspective. From the consumer's perspective, he's not doing so great. Half of this country is sort of not doing so great, and they're facing higher everything prices, particularly gas now. And so if the U.S. is a consumption economy, you would expect consumption to get weaker.
Yeah.
And we'll see if it happens. You're already seeing changes in travel patterns. Americans aren't going to Europe this summer.
Yeah.
Their travel to Europe's down like 10% from the United States.
Does that worry you, though? I mean, that some of these changes aren't just temporary, that they could be long-term structural shifts?
No, I don't. What worries me is, yes, the disparity of wealth in the United States and the fact that half the country isn't doing so great, that worries me. Because it will impact politics. And if it impacts politics, it'll impact real estate. It'll impact taxes. It'll impact a lot of things. Yeah. So I think as investors, we've shied away from blue states lately because of their propensity to tax businesses and individuals, and that's showing up in higher growth rates in the Sun Belt states, which are oversupplied in the United States. Yeah. But that's where the job growth is, and eventually they will grow into their supply. There's not a lot of new supply. where some of the blue states, are losing jobs and they don't have a lot of supply, but they won't. 5 years, 10 years from now, they won't be outperforming the Nashvilles, the Dallases, the Atlantas, the Raleighs, pretty much the entire state of Florida.